The first week of 2026 just handed us a masterclass in human predictability. While every Wall Street strategist, literally every single one, predicts another rally this year, the market delivered something far more interesting. A failed Santa Claus rally, the Shiller P hitting levels seen only 5 times in 155 years, and a collective case of cognitive dissonance so severe it's almost entertaining. Here's what makes this exploitable. Markets don't reward consensus, they punish it. And right now, consensus has never been more crowded or more wrong about what's actually happening beneath the surface. The numbers tell a story that most are missing entirely. The S&P 500 dropped 1% for the week while the Dow outperformed. Semiconductors rallied on AI promises, but software names got hammered. Tesla missed delivery forecasts for the second straight year. The VIX sits at a complacent 14.51, even as bond yields spiked to September highs. Meanwhile, international markets outperformed U.S. equities by the widest margin since 2009, 30% versus 16%. These aren't random data points. They're behavioral signatures of a system under stress, and stress creates opportunity for those who understand what they're actually looking at. Let me show you exactly how human psychology is setting up the next major market exploit. The human layer driving this market is pure loss aversion psychology, meeting recency bias head-on. After 3 consecutive years of double-digit returns, investors face an asymmetric fear structure. The pain of missing further upside feels manageable. The terror of giving back gains, paralyzing. This creates what I call the late-cycle prisoner's dilemma. Everyone knows valuations are stretched. The Shiller P just crossed 30 for the 6th time in 155 years. The previous 5 instances, followed by declines of 20 to 89%. Everyone knows AI capital expenditure promises need validation. Everyone knows the easy money has been made. But here's the beautiful part. No one wants to be first to reduce exposure while momentum persists. So they maintain positions not from conviction, but from fear of relative underperformance. This creates fragile equilibrium where small catalysts trigger cascading repositioning. The divergence between semiconductor strength and software weakness exposes the critical psychological shift happening right now. Investors are finally differentiating between infrastructure providers with tangible demand and application layer companies facing mounting skepticism about return on investment. This selectivity marks the transition from indiscriminate risk appetite to fundamental scrutiny, a behavioral shift that typically precedes broader multiple compression. Meanwhile, tariff uncertainty and Federal Reserve leadership chaos introduced exogenous volatility into an already fragile sentiment structure. Markets hate uncertainty more than bad news, and the Trump administration's unpredictable policy trajectory creates option value in waiting. The Crypto Fear and Greed Index, sitting at 34 despite Bitcoin near $88,000, confirms this risk-off undercurrent extends far beyond equities. Now here's how the system absorbed these behavioral forces and what it reveals about the exploitable patterns emerging. The market's internal structure is fracturing in real time. Index-level performance masked massive rotation, capital flowing from growth to value, from speculation to stability. The Russell 2000's Friday surge suggested small-cap positioning ahead of potential Fed easing, but the weekly decline confirmed this was tactical theater, not strategic conviction. The Magnificent Seven dropping 1% despite semiconductor strength indicated concentrated selling pressure in the largest market cap names. This is algorithmic rebalancing and systematic profit-taking amplified by holiday liquidity, but it's also something deeper. The market's narrow leadership is fracturing. Bond markets provided the clearest signal of system stress. The 30-year Treasury yield hitting its highest level since September, despite equity weakness, means inflation expectations are rising or term premium is expanding. This decoupling between stocks and bonds eliminates a key diversification mechanism and forces portfolio managers into uncomfortable choices. When German and UK yields rise in parallel, you're looking at structural repricing, not US-specific noise. Commodity behavior told a parallel story. Gold and silver building on their best year since 1979 reflects persistent debasement fears. Aluminum crossing $3,000 per ton signals industrial demand expectations remain intact despite manufacturing weakness. This divergence between financial assets and real assets, markets pricing stagflationary scenarios even as consensus forecasts remain optimistic. The crypto market revealed institutional caution despite retail optimism. Bitcoin hovering with muted volatility, ETF outflows of $348 million on year-end, fear and greed, stuck in fear territory. Large holders are not adding exposure. The marginal buyer has stepped away. Technical indicators painted exhaustion, not reversal. The S&P 500 posting only 3 new 52-week highs against 1 new low, while Nasdaq recorded 29 highs versus 218 lows. The market's narrow leadership isn't just fracturing, it's collapsing. So, what's the stoic response to a system transitioning from momentum-driven to fundamentally driven behavior? First, recognize this transition is necessary and healthy, though uncomfortable for participants conditioned to expect linear appreciation. The divergence between semiconductor infrastructure and software applications represents markets performing their proper function, capital allocation based on tangible value creation rather than narrative appeal. The failed Santa Claus rally triggered pattern recognition anxiety, but historical precedent offers limited predictive value in complex adaptive systems. What matters is not whether January predicts the year, but whether portfolios are structured to withstand multiple scenarios. The current environment rewards anti-fragility, positions that benefit from volatility rather than suffer from it. The Federal Reserve's internal divisions create fog that cannot be penetrated through analysis. The stoic response is not to predict policy outcomes, but to position for a range of possibilities. Rising long-term yields despite equity weakness suggest markets are already pricing reduced central bank credibility. This repricing continues regardless of who chairs the Fed or what they say. Valuation extremes don't guarantee imminent collapse, but they do guarantee future returns will be lower than past returns unless earnings growth accelerates dramatically. The disciplined approach is to reduce exposure to the most expensive segments while maintaining participation in areas where valuations remain reasonable. The international equity outperformance, 30% versus the SP's 16%, signals U.S. exceptionalism is being questioned. This isn't bearish for U.S. markets, but a reminder that concentration risk carries consequences. Diversification across geographies, asset classes, and strategies is about surviving the inevitable periods when correlations break down and leadership rotates. Here's the week ahead. A deluge of labor market data that will either confirm or challenge the soft landing narrative. Strong employment supports the economy but delays Fed easing. Weak employment enables easing but raises recession concerns. Both scenarios create volatility. The prepared portfolio is positioned for volatility itself, not for a specific direction. The market's message is clear. The easy money has been made. What comes next requires selectivity, discipline, and the willingness to act contrary to consensus when probabilities favor it. The herd is positioned for a fourth consecutive year of gains because every strategist polled predicts it. This unanimity isn't comfort, it's warning. Systems under stress reveal their true nature. This market is stressed by valuation, by policy uncertainty, by geopolitical risk, and by the gap between AI promises and AI profits. These stresses won't resolve quickly or cleanly. They will create opportunities for those who remain liquid, patient, and disciplined. The game is no longer about riding momentum. It's about surviving the transition to whatever comes next. If you value systematic thinking over emotional noise, if you prefer exploiting human predictability to being exploited by it, then subscribe to this channel. The link in the description contains the complete framework for identifying and capitalizing on these behavioral patterns as they develop. Because while the crowd chases consensus, the disciplined few position themselves for what consensus refuses to see.